Welcome. In this video, can Zbcn coin rise 22x and make us rich? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand. In financial markets, various technical formations and trend structures are used in chart analysis to understand the trends of price movements over time. One such structure is the descending curve, or in other words, the descending trend line. A descending curve forms when the price consistently makes lower highs and lower lows over a given period. In other words, even when the market recovers, it remains below the previous high and each decline falls below the previous low. This shows that sellers dominate the market while buyers fail to push the price upward in a lasting way. The descending curve typically appears on a price chart as a line running from the top left to the bottom right. This curve also reflects investor psychology. Sellers view every rise as a selling opportunity, while buyers act cautiously due to uncertainty. As a result, the price consistently moves below this curve. However, such a structure does not last forever. At some point, either the seller's strength weakens or buyers become more dominant. This is when the breakout of the descending curve comes into play. Breaking the descending curve is a very important event in technical analysis. This can signal the end of the existing downtrend and the potential start of a new uptrend. The breakout of a long-standing descending curve can create a psychological shift in the market. Buyers become more confident while sellers begin to retreat. If this breakout is supported by a strong increase in volume, it is considered more reliable. Volume is a critical indicator in this process. If the price breaks the descending curve while trading volume rises, this shows strong buying interest and suggests that the breakout is not a false move. However, if the volume is low, there is a risk that the price will fall back below the curve. For this reason, experienced investors look for volume confirmation at the moment of the breakout. The breakout of a descending curve can occur in two different ways. The first is a sudden and strong move, a kind of breakout explosion. This type of breakout can cause the price to rise quickly and test significant levels in a short period of time. The second type is a slow and cautious breakout. In this case, the price tests the curve several times, even moving slightly above it before returning below, but eventually moves upward decisively. After the breakout, the price often performs what is called a retest. This means the price returns to test the broken descending curve. This movement is important for confirming the strength of the buyers and showing that sellers have lost control. If the retest is successful, the price resumes its upward move, starting a new trend. At this stage, investors often consider buying since the risk-reward ratio becomes more attractive. From a psychological perspective, breaking a descending curve can dramatically shift market sentiment. Investors who have endured a prolonged decline begin taking positions once convinced the downtrend is over. This creates increased demand. Large investors and algorithmic systems that follow technical analysis often place buy orders at such breakout points, helping the price rise even faster. Breaking the descending curve can signal not only short-term but also medium and long-term trend changes. If the breakout appears on a weekly or monthly chart, it is a much stronger reversal signal. Such a breakout could mark the start of a new uptrend that lasts for months or even years. From a risk management standpoint, when taking positions after breaking the descending curve, it is logical to place the stop-loss level just below the broken curve. This way, if the breakout fails, losses are minimized. When setting target prices, past significant resistance levels and formation targets should also be considered. Many successful investors view descending curve breakouts as opportunities with high profit potential. This is because such a breakout symbolizes a major change in the market both technically and psychologically. However, as always, these opportunities should be evaluated with careful analysis and disciplined trade management. In summary, the descending curve acts as a form of pressure and directional guide in the market.
As long as the price remains below this curve, the downward trend continues. However, if the price breaks this curve, it is usually one of the most important signs that buyers are gaining strength and that the market direction may change. If this breakout is supported by strong volume, the subsequent upward movements can be very rapid and significant. For this reason, investors closely follow descending curve breakouts and try to act at the right moment. Such a breakout is a technical development that can play a major role in investment strategies and lead market reversals. But we can't make decisions based solely on the curve. Let's take a look at other metrics as well. Stay tuned.
Bollinger Bands are one of the most popular indicators used in technical analysis to understand price volatility and potential trend reversals. This indicator consists of a middle band and two bands positioned above and below it. The middle band is typically a simple moving average of a specific period, most often 20 periods, while the upper and lower bands are lines plotted a certain number of standard deviations above and below this average. This structure helps us see the range within which the price normally moves. The middle band represents the underlying trend and average value of the price. In other words, if the price is moving above this band, it is generally considered to be in an uptrend, while moving below it is considered to be in a downtrend. However, it is important to note that Bollinger Bands are not used solely to determine direction, but rather to assess the position of the price and the level of volatility. Now, let's look at the scenario you mentioned when the price breaks the middle band. In Bollinger Bands, if the price is moving above the middle band and then suddenly breaks it downward, this often signals weakening momentum and increasing selling pressure. Moving below the middle band is an important signal that the price may head toward the lower band. Statistically, as long as the price stays within the bands, it tends to move from one extreme to the other. For example, if the price has been moving just above the middle band for a long time and then breaks it with a sudden wave of selling, this shift changes the perception of market participants. Buyers start acting more cautiously, while sellers become more aggressive. This can push the price toward the lower band. The lower band is often seen as an area where downward movements may be limited or at least slow down, since it statistically represents levels close to oversold conditions. In the mathematical logic of Bollinger Bands, price movements generally remain within the bands more than 90% of the time. This means that when the price moves below the middle band, the probability of it reaching the lower band is high. The level of volatility is also important in this process. If the bands are wide, the movement toward the lower band can be sharper and faster. If the bands are narrow, the move may be slower but still steady. Breaking the middle band is significant not only technically but also psychologically. The middle band is viewed by many traders as a balance point. When the price falls below this balance point, many traders interpret it as a sign of trend weakness and may start reducing or closing positions. This can further increase selling pressure and accelerate the move toward the lower band. However, another important factor to watch is the strength of the break. If the price breaks the middle band with weak movement and low volume, the move may not be sustainable. In such cases, the price might quickly move back above the middle band. But if the break occurs with high volume and strong momentum, the likelihood of reaching the lower band becomes much higher. Such breaks in Bollinger Bands often provide important clues about the short-term direction of the market. For some traders, the move from breaking the middle band toward the lower band signals a selling opportunity, while for others, it may indicate a buying opportunity once the price reaches the lower band. This is because the lower band often represents areas close to the price bottom from which a rebound may occur. Traders who use this strategy typically enter short positions when the price breaks the middle band and set the lower band as their target. They place their stop loss just above the middle band to limit their risk.
This way, they protect themselves from potential reversals. During the process of the price moving from the middle band toward the lower band, it is important to confirm the signal with other technical indicators. For example, if the RSI indicator is approaching the oversold zone, the probability of a rebound increases when the price reaches the lower band. The MACD indicator,
an ascending channel structure, is one of the formations in technical analysis where the price moves within certain upper and lower boundaries in line with a specific trend. This type of channel indicates that the market is in a steady uptrend, and the price usually oscillates between the lower and upper bands of the channel. In the middle of the channel, there is often a midline or trend line. This midline plays a critical role in measuring both the short-term direction of the price and the strength of the trend. Technically, the midline can often act as both support and resistance. Now, let's look at the scenario you mentioned. If the price crosses above the midline of an ascending channel, it has strong potential to rise to the upper band. The fact that this potential corresponds to as much as 22 times is an indication that this move would be a very significant development both technically and psychologically. This is because breaking above the midline is often a sign that the trend will accelerate and the price will begin testing the upper boundaries. We can think of the midline in an ascending channel as a kind of equilibrium line. When the price is trading below this line, market participants are generally cautious and buying activity may remain limited. However, when the price breaks above this line, market perception changes. For most traders, this breakout signals that the trend has strengthened even further. As a result, buyers become more aggressive while sellers start to retreat. This psychological shift allows the price to gain momentum and speeds up the rally. In such a scenario, breaking above the midline is seen not only as a short-term signal, but also as confirmation of the medium-term trend. In other words, the probability of the price reaching the upper band increases. A 22x potential represents a major opportunity for investors. Such a return is extremely attractive for both spot traders and those using leverage. However, the key point here is whether the breakout is false or genuine. In some cases, the price may briefly move above the midline, but then fall back below it, misleading investors. One of the most important confirmations of a genuine and strong breakout is trading volume. If volume increases significantly during the move above the midline, it shows that buyers are committed. A breakout without volume, on the other hand, is usually not sustainable, and the price may quickly reverse. Therefore, investors looking to capitalize on the 22x potential must check for volume confirmation. Once the midline is crossed, the distance the price can move toward the upper band becomes clearer. Ascending channels are generally continuation formations in the direction of the trend, and reaching the upper band is often inevitable. However, along the way, intermediate resistance zones, psychological price levels, and profit-taking can influence the pace and duration of the move. As the price advances toward the upper band, it may occasionally make pullbacks, which helps the uptrend continue in a healthy manner. From a technical standpoint, breaking the midline is also considered a buy signal. Many traders open positions after such a breakout and set the upper band as their target. In terms of risk management, stop-loss levels are typically placed just below the midline. This way, losses are kept to a minimum in the event of a false breakout. Psychologically, such a breakout creates a positive atmosphere in the market. Especially on social media and in investor communities, the news that the price has crossed the midline spreads, attracting new buyers into the market. The entry of these new buyers increases demand and contributes to a faster price rise. This chain reaction can cause the price to advance rapidly toward its 22x potential. In ascending channel formations, sustained moves above the midline generally signal one of the strongest phases of the trend. This is because at this point, the market has found strong support both technically and fundamentally. If this move is supported by positive news flow or a broader market uptrend, reaching the target becomes even easier. In such a case, investors' strategies should take into account both the strength of the trend and risk management.
While a 22x potential is appealing, the fact that market conditions can change suddenly should not be overlooked. Taking partial profits at intermediate levels on the way to the target reduces risk and helps protect gains. Finally, it's important to consider possible scenarios after breaking the midline. If the price enters overbought territory before reaching the upper band, it may trigger a pullback. However, such a pullback usually doesn't break the main trend, and the price typically resumes its upward move toward the target after a while. The key is that the main trend remains intact. In short, breaking the midline of an ascending channel is a very strong technical signal that the price may reach the upper band. The 22x potential clearly shows how significant an opportunity this move presents. However, investors should always confirm with volume, manage their risks, and consider market psychology when trying to take advantage of such opportunities. With the right strategy, such a move can create substantial value in an investment portfolio.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.